Good morning, traders. It's Thursday, April 16th. Taking a look at the charts, the equities are up a little bit this morning, up a third of a percent or 0.6%, depending on the index. NASDAQ up a little bit more as it typically outperforms with the tech. Overall, though, you can see here the market is struggling. It's holding here, trying to hold stability on the short term to continue to push higher up towards our next target, which really isn't a whole lot higher than the high we saw or more or less yesterday or the day before. But overall, the market is really testing this critical level. If we zoom out on the chart a bit here, let's just draw a line in the sand. If we were to draw a line right across this area, you can see how significant this area is, where we've had price tag it, break through it with a gap. We had a bunch of volume trade through here, very significant lows here, pretty much tagged it there. Again, we tagged it here, had a couple days back and forth there, and now we're starting to show some signs that obviously a little bit of resistance here. Anyone who bought at this level going back in time, after they go through this roller coaster ride of being down a lot of money and getting back to break even, this creates a resistance area. They say, just get me out here. And that's what creates that selling pressure in the market. Now, hopefully we'll see this continue to move up, but this is a very critical line in the sand for the equities market. The market could very easily roll over here and continue to sell off. And if we look at the even the short-term chart here of the SP 500, we are in an uptrend, so it should go to the upside, but keep in mind this was a big gap to the downside, and yesterday still is somewhat of a short-term bearish pattern, and this could come down and flush lower to test these lows, and potentially our entry price was right over here where the market changed from a downtrend to an uptrend. We pulled some money off over here with some profits. And now our stop is at this red line. So there's potential we get stopped out here. If the market does start to break this low, we could very easily see another big sell-off, a double dip in the equities market, and we don't want to be holding long there. This is why we need to be aggressive with short-term moves, initial targets when we get to these, close to these major resistance levels. I don't always pick right at the resistance. I usually pick under them because a lot of times price will fall short of those resistance areas and roll over without tagging it fully. Now let's take a look over at bonds this morning. Bonds are trading higher, about 0.4%. They had a really nice pop there yesterday. Again, these big patterns of bonds, big rally, big consolidation, big rally, multi-month consolidation, big rally, and we are consolidating here. Overall, it's bouncing off the 20-day moving average. It bounced there. It's bouncing here. It continues to kind of work itself into this wedge, and more or less, if we were to just connect these bottoms and more or less these tops here, this is going to be kind of a pretty critical level in the sand. And really, a lot of different asset classes are actually showing some big movements going to happen. I've been talking about this earlier this week, that this could be a very pivotal week in the markets. Bonds are on the verge of breaking to the upside or breaking down out of this is actually a very, very big pattern here. If you look at relationships between bonds and gold, the pattern there, and gold and real estate, and even the high yield corporate bonds versus treasury bonds. There's a lot of different things at play here that are all building up patterns somewhat similar to bonds, but they're all on the verge of breaking out of these relationships, these different ratios and moves. All these patterns are building up for something really big to happen. And the big question is, does the equities market extend and move higher for a bigger dead cat bounce and a stimulus kind of backed rally to go much higher and hit our larger targets? Or are we going to see the equities market roll over for a double dip and all the safe havens like gold, bonds start to take off again and move higher, and equities sell off? And that's the big pivot point that we're at with the equities market this week, which is right on this chart. You can see here, if we can start to extend, we are going to be moving up fairly substantially to the upside. If it rolls over, we are most likely going back down for a double dip, and things could actually get a lot uglier. And if we just go way back in time here and take a look at the chart here, a lot of times we get a double dip before we get a significant rally. If you look over here, we had a big crash, came back down, got close to a double dip before having another big bounce that lasted a couple months, came back down, bounced up with a strong rally, had a double dip before moving higher. Even this one over here sold off, had a big rally, had a double dip before having the next big run, and then over here it really consolidated and went to a washout V-shaped recovery, a little bit different, but overall we are in this. Are we having a V-shaped recovery and back up into this 3,000 mark, or are we going for a massive double dip, potentially even a breakdown in a big way? And these double dips happen all the time, so that is my concern. And this is that line in the sand where if we're going to get that double dip, this could very much be it. Now, don't get me wrong, I think we're going to have a double dip eventually, even if this continues to work itself higher. I think eventually we're going to see it come back down. It's going to have some type of double dip. The question is it going to trade in a big range like in 2015, or does it actually start to break down even more and head to, we're talking a multi-month bear market getting started potentially. So that's why we just need to follow the technicals, follow price, and we got to be really cautious with our trades at this point, because this is pretty much a halfway mark. You look at the high, you look at the low, it's pretty much bounced into the middle range, and when you zoom in on the charts, we're going through a lot of significant pivot highs and lows where this is an area of resistance. All right, let's take a look over at gold. Gold and silver up again this morning. They were down yesterday, up today. Gold going up, pushing these highs. Obviously, gold has broken above this 1700 resistance area. It's holding its ground fairly well here, and it is definitely outperforming all the other metals in terms of which one's making a new high versus silver and miners not even close to their highs. You can see silver here up about 2.25% this morning, continuing to trade at this little first area of resistance. We'll see if it's going to extend and continue, or if we're going to see the equities market start to rally and we see the safe havens fade off a little bit here. Overall, huge moves in these markets, and now they're consolidating. There may be an opportunity for us to get in and take a play in silver, gold, or miners. But overall, I'm being pretty picky, looking for a good trade, because this is still a really volatile market. And if we take a look over at the gold miners still, we talked about it yesterday. As of yesterday's close, gold miners are still down almost 20% from where we got out up here, and we're letting it kind of do its thing. Huge. This almost looks like a blow-off type pop in the market where we had this pattern and kind of a hook to the upside. It could very easily sell off and consolidate. This is huge volatility and gaps in the market. Really would like to see this stabilize, get us some type of normal price action without 10 to 20% price swings on a more or less on a daily basis and even weekly basis. Let this market kind of stabilize a bit, but not in a huge rush to get in just yet. We can always get in later. It doesn't matter if we get in lower or higher. The key is we want to get in when risk is low, and we're not going to take a 5 or 10 or 15% haircut the very next day trading during this volatile time in the market. Now, I know a lot of people are into the 3 times leverage, which I've talked about many times, are extremely deadly. Had a few emails, people asking about JNUG, which is the triple leverage junior miners, and it went from 104, which is the price that the day we got out at the high at the open, and now it's at 674. And this is the reason why those triple leverage just can absolutely kill. They can blow up. It's happened in volatility indexes, the VIX index, ETFs, all kinds of things. But more or less, it's dropped about 97%. It's done. It's busted. There's no point in trying to trade it. I think they all got downgraded to 2 times ETFs, and you can just see it used to have massive volume, but now look at the volume here. This is all the funds. This is everyone getting out of this ETF, which is why it's just completely clobbered. And more or less, the formula is broken. And I find it amazing that the SEC and the regulations even let funds that can blow up more or less in a few days be even traded. It shows zero protection to the end user, and it really blows my mind how ridiculous the system is sometimes. But anyways, gold miners are still kind of struggling. If we go back to the large caps, the large caps have been testing these highs. They have been performing second best, so gold's best. The large caps are back up testing these highs, and the silver and the juniors are still underperforming significantly. But the gold miners here, this is a nice pattern. If we can get it to consolidate and tighten up here a little bit, look at the weekly chart of the large caps. Let's go way back in time here. Just look at this pattern. Look at this significant blue line. It's major resistance. Clearly, it was traded through a lot back over here in 2009. A bunch of weeks traded through it over here. It's pretty condensed. But and then some price got close to this line, showing close enough that this is a major support level when price gets here. So when you're under that, it's a major resistance area. But you can see how it got rejected again. Virus had a good part of that, but it was rejected, and that is what we were expecting, and that's the reason we got out of gold miners at that high above resistance. The market makers, everyone's watching this line. The market makers gap the price up above that, and that is a big red sign. When you've got a resistance area that the whole world is watching and the market makers walk it up overnight and to get above that resistance area, you got to expect it's going to sell off, and it's a trap. It's going to get a lot of shorts out. It's going to get the market makers on the right side of the play, and it's going to completely crash in their favor. And that's what happened, and it played out perfectly in our scenario. And now it's back up to this area. So if we can consolidate and build a launch pad, at this point, the large caps are the next to break into a bull market. And if we take a look at gold, here's gold on the same chart. Gold already broke out last year, and we started to break out right across this first blue line. We'll just move this out of here. This was the significant breakout zone, and gold's been on its way higher. We played some of this last year, and now the gold miners are the large caps gold miners are ready to do this as well. They're getting close. So it doesn't matter. Gold juniors are way down here. Still silver's in this bottoming phase. We want to find an asset breaking into a new bull market and take advantage of it. The large caps, I think, are the way to go at this point, just because they are outperforming, just like gold was. Everyone expected silver to be the big mover, and of course gold moved. Everyone wants the small gold juniors to move. Well, it's probably going to be the large caps. It's always, what the masses aren't thinking. So it's getting exciting for the large caps going forward. Here's silver on the weekly chart, just so you can get a view. We are still making lower highs, lower lows. It's got a lot of upside potential before it can even break out. But again, really noisy, ugly chart. Once it starts to break this level, and this level, I think we'll be off to the races. But at this point, it's still struggling. Really noisy chart, and it's still clearly in a downtrend. You could argue it's really still in a bear market because it is making lower highs and lower lows still. All right, let's take a look over at energies real quick. Natural gas, I am going back to the daily chart. Here's natural gas. It is still with that pop and fade. It continues to have this pop and fade, and we'll see how things play out here. Overall, we have seen a couple double dips. We see a pop and a fade with a double dip. Then we get a pop, a fade, and a double dip. We've got a pop, another fade. Are we going to go to new lows? I don't know. But we could very easily get another double dip. And eventually, this volatility, you can see here, price is narrow in this range, just out of favor, just a slow grind, everyone getting out. But now we're seeing these pops. This is volatility. So we're starting to see, I think, the market try to put in a bottom here, and eventually we're going to have some type of breakout going forward. But again, it is not there yet. Yesterday afternoon, the momentum shifted back to the downside in terms of natural gas. So now it is neutral / down. So overall, it's got a lot more work to do there, probably a few more weeks at least. Before we potentially get a new signal there. Crude testing this $20, $19 per barrel level. This is a pretty significant range that it's trading in, these highs down to this low. Whichever way it breaks, it's going to have a pretty significant move, and there's just continuous oversupply of crude, and you got to think this is going to break to the downside. The trend is down, has a bear flag, sells off, has a bigger bear flag. This is a big floor that if this is broken, we're looking at $17 or $14 per barrel. But again, the risk here, I like this. It looks really good, but the problem is it has a 50% move in 2 days based on rumor or news talks with OPEC, and I have a feeling there's going to be another type of headline news that's going to move crude either sharply higher or sharply lower, and it's really dangerous to trade something that moves 50% in a couple days based on news and you don't know when it's coming out. This is a high risk trade. It looks good, but I mean, it carries a lot of risk, and it's these type of trades that one bad trade like this can really damage your account for the whole year and take you a while to claw back a 5 or 10% potential loss on even a small account. A trade on it would still be multiple percentage down on your overall portfolio, and that's not what we want. Anyways, that is it for this morning, and I'll talk to you in a little bit. Take care. Bye-bye.